Morning, everyone. Welcome to our webinar on 365 days of VAT in Oman. My name is Abha Lekhak. I'm a partner with KPMG's indirect tax practice based out of Muscat. I've been in the region for close to 4 years and lead all the indirect tax initiatives for KPMG in Oman. I'd like to welcome you to our last of the 6 webinar series that we've had on different sectors. Today we focus on the consumer and retail sector. Before I introduce the agenda and the speakers, a few housekeeping rules. We encourage questions. So on your screen, on the right-hand side, you can see a Q&A tab. Please post your questions in the Q&A tab. We will try and take them at the end of the session. We've allowed about 10 minutes before we wrap up the session for today for Q&A. Please feel free to post your questions anytime during the course of the session. Don't wait towards the end. We will request you to provide your feedback at the end of the webinar. You will be directed to a feedback survey. Please take a minute to provide your inputs. Your feedback will allow us to curate our sessions in the future. And lastly, a recording of this webinar will be shared with you after the webinar and also posted on social media. In today's session, we will walk through the key developments in VAT, the key VAT positions, especially in the context of consumer and retail sector, procedural reliefs extended by the tax authority, our experience of compliances in the last 1 year. We'll then talk about some issues businesses in the consumer and retail sector still need to consider, the next steps on mission critical items for businesses, and at the end, Q&A. On the session today, I'm also joined by Manak Chugh and Mohammad Al-Oremi. Manak is an associate director with our indirect tax practice. He's also based in Muscat, has been in the indirect tax advisory and compliance space for close to a decade now, and has been in the region and in Muscat for over a year. While he works with clients across sectors, one of his specializations is the consumer and retail sector. Mohammad's been with us for more than a year now, and during the year, he has worked on a lot of indirect tax advisory and compliance matters and has built a great rapport with the tax authority here in Oman. With that, let's kickstart today's session. To allow you a snapshot of the developments in the last 1 year, VAT was introduced in Oman on the 16th of April 2021, introduced in a phased manner like Bahrain and KSA. The registrations were phased over 4 phases spread over 1 year. The last went live on the 1st of April 2022. So pretty much everyone who was supposed to have been registered for VAT should have been registered by VAT, should have been registered for VAT in Oman by the 1st of April 2022. In terms of the tax authority's efforts, obviously, a lot of investment has been made by the tax authority in ensuring information and clarifications and guides are disseminated to taxpayers on a periodic basis. There have been teething issues, but that's both for the taxpayers as well as the tax authority. In terms of the information available so far, we've had decisions from the tax authority, largely on 3 subjects: registrations, where they've communicated the monetary threshold for voluntary and mandatory registrations, as well as the phasing of registrations, the list of items eligible for 0 rating, and I mean food items, the list of goods, medicines and medical devices eligible for 0 rating. And we'll talk a little more about this in the subsequent slides. They've issued sector-specific guides, and although we do not have a guide on the consumer and retail sector, the consumer guide is only a guide for end consumers, not a guide on the sector as such. In today's session, we'll be drawing from our experience of dealing with the tax authority in Oman, looking at practical issues that businesses in the sector have had to face, and the guidance available in the region. So this is not based on a guide. This is based on guidance generally available. In addition to sector-specific guides, the tax authority has also issued guides on procedural matters, and we would encourage each taxpayer to look at all guides, because some of the principles set out in other guides which are not relevant to your sector may help you take certain tax positions. In terms of other communication, we've had the tax authority issue the notice on simplified tax invoices, allowing taxpayers a relaxation from obtaining an approval from the tax authority for issuing simplified tax invoices. They only need to notify the tax authority to be able to issue simplified tax invoices. The tax authority has also clarified that supplies made to government bodies will be treated at par with private bodies. There is no special rule or relaxation for supplies made to government bodies or quasi-government bodies. Apart from that, ministries and government bodies involved in a particular sector have also been communicating with taxpayers by way of circulars and notices. With that, we can move on to the next section on key VAT positions, and I'll ask Mohammed to come in and kick off this section with an overview of the key VAT positions under Oman VAT.
Thank you, Abha. Thank you so much. As you are aware, VAT in Oman is applicable on supplies at the standard rate of 5%, unless the supply is specifically exempted, zero rate is suspended, or outside the scope of Oman VAT. As a quick refresher here, in an exempt supply, the supplier can neither charge VAT from the customer nor recover any input VAT incurred on purchases used to make such supplies. On the other hand, in a zero-rated supply, the supplier can charge VAT from the customer at 0% and recover any input VAT incurred on purchases used to make such supplies, subject to normal input VAT recovery rules. Also, in an out-of-scope supply, the supplier cannot charge VAT from the customer, but depending on the nature of the transaction, may be able to recover input VAT incurred on purchases used to make such supplies as well. Finally, in a standard rated supply, the supplier can charge VAT from the customer at 5% and recover any input VAT incurred on purchases used to make such supplies, subject to normal input VAT recovery rules. So how does one assess whether a supply is standard rated, exempted, zero rated, suspended, out scope of for the purpose of Oman VAT? Well, that's based on the Oman VAT legislation. The Oman VAT legislation lists supplies that are exempted, zero rated, suspended, or outside the scope of Oman VAT. So as you can see here, this slide captures key supplies which are exempted, zero rated, or outside the scope of Oman VAT. Firstly, when affected within Oman, supplies exempt from VAT include healthcare services, local passenger transportation, financial services, and some supplies related to real estate. Secondly, when affected within Oman, zero-rated supplies include specified food items, specified medicines and medical equipment, investment in gold, silver and platinum, international transportation, and supply to customer in notified special zones. On the other hand, when affected outside Oman, goods and services exported from Oman qualify for zero rating. Thirdly, some supplies that are outside the scope of Oman VAT include supplies between members of a VAT group and transfer of business on ongoing concern. Please note, a special treatment usually comes with conditions attached, so the exemptions and zero ratings are subject to fulfillment of all the conditions prescribed under the Oman VAT legislation. With that, I'll hand over the presentation to Abha to discuss the key VAT positions in the consumer and retail sector.
Thanks, Mohammed. So, as Mohammed mentioned, obviously this sector is eligible for certain special treatments, specifically when you look at the zero rating for food items. And as Mohammed rightly pointed out, all special treatments come with conditions applied. So before you adopt a special treatment for any of your transactions, you want to make sure that you understand the conditions entirely and are compliant with them before you take a certain tax position, which is not standard rating. When we look at zero rating for food items, the tax authority initially listed over 90 products which were eligible for zero rating. Over time, by way of subsequent decisions, the tax authority has expanded this list. The first revision took it to 488 items with certain additions and deletions to the original list, and the current list has about 513 items. It's important that taxpayers monitor how the list is updated to ensure that any additions or deletions are appropriately considered when you're looking at system upgrades and tax treatments. Similarly, for zero rating that is available for medicines and medical devices, it's not a blanket zero rating. It is only in respect of specified medicines and medical devices. This includes herbal medicines, allopathic medicines, certain health products, as well as food for dietary requirements. But it comes with the condition that these products are subject to MOH's permission for release under the Common Customs Law, and the MOH has also issued the list which qualifies for zero rating. That list is a HS code plus description based list. So unless your product, and when I say your product means by way of HS code plus the description, does not appear on the list that is issued by the MOH, you will not be eligible for zero rating. Also note that the list that is issued by the MOH is updated on a regular basis. So it's important that businesses monitor the list to make sure that they're not claiming zero rating, which is no longer eligible, or vice versa. So far as healthcare and healthcare related goods or services are concerned, this is an exemption. So different from a zero rating. But in terms of conditions, this one also comes with several conditions. While there's an illustrative list of healthcare services that is provided in the legislation which is eligible for the exemption, it's important for businesses to note that the exemption only applies when the healthcare services and goods and services related to healthcare are provided either by medical professionals or medical institutions. Anyone, any business, any taxpayer other than medical professionals or medical institutions supplying these will not be eligible for the exemption. Similarly, the exemption also carves out or makes exclusions for any goods or services that are supplied which are commercial in nature. So, for example, in the context of a hospital, when there's food or drinks which are sold in the cafeteria for visitors or at any dispensary, there's parking fee which is charged, or any fee for entertainment of the patient which is available in rooms. All of these are considered as commercial supplies, not a supply of healthcare and healthcare related services. So these will not be eligible for the exemption. Moving on to the next slide, let's look at some of the key concepts under Oman VAT and how these apply, or certain exceptions to these given the interpretation of the legislation in the GCC countries or by the tax authority in Oman. Just a caveat before we start these slides is that this is not a professional advice. Each taxpayer would have to look at the transaction, would have to look at the contracts, the accounting treatment, and assess the tax position on a case-to-case basis. What we are offering over here is just guidance or criteria that you need to look at when you're assessing the taxability of a particular transaction. So let's first start with consideration. If you look at the VAT legislation, consideration is anything that a supplier receives or is expected to receive for the supply, either from the recipient or from a third party making that payment on behalf of the recipient. Now, it's not just consideration in cash, but it also includes consideration in kind. If you look at the VAT legislation, it allows for certain inclusions and exclusions from consideration. Let's look through what these are. First, which is a common phenomena in the consumer and retail sector, is discounts. Trade discounts, which are offered on the face of the invoice. The VAT legislation clarifies that trade discounts can be reduced from the value of taxable supplies, which means that VAT will be payable, if applicable, only on the price realized net of discounts, provided the value of the discount is clearly mentioned on the tax invoice and the supplier has a written policy with respect to the discounts and the reductions which are claimed as a deduction. Unless both these conditions are satisfied, the taxable supply value cannot be reduced by the value of the trade discounts. The VAT legislation also recognizes post-sales discounts and allows for a reduction from the original taxable value, provided certain conditions are satisfied. The conditions essentially require that the supplier has a published, consistent, and commercial policy for the discounts before the discounts are extended. The supplier extends the discount by issuing a valid credit note to the customer or the recipient, and the reduction or the adjustment in the taxable value is also reflected in the accounting records of the supplier. There is also a reciprocal requirement cast on the recipient, which is where any credit note is received, which in effect reduces the value of the original supply, and as a result, the VAT on the original supply. The recipient should reduce the input tax credit claimed on the original purchase to the extent the VAT is reduced by way of the credit note. Now, the VAT legislation also recognizes the concept of reimbursements or disbursements, again, a common phenomena in the consumer and retail sector. What do I mean by reimbursements? Reimbursements are essentially expenses or recoveries made by the supplier from the recipient for expenses that are incurred by the supplier in its own name, i.e., not in the name of the customer or the recipient. In such cases, wherever there is a reimbursement, it would be added to the taxable value and will be liable to VAT to the extent VAT is applicable. But when it comes to disbursements, the VAT legislation as well as guidance available in the region makes a specific carve out where any amount that is recovered in the form of disbursements is not required to be offered to VAT. It is treated as outside the scope of VAT. When does a particular recovery uh, take the nature of a disbursement? Well, this is not necessarily elaborated or detailed in the VAT legislation, but whenever the supplier incurs an expense in the name and on behalf of the customer, and incurring such an expense is essentially the legal responsibility of the customer, you can say that the recovery, when made by the supplier from the recipient, is a disbursement. If you look at guidance available in the region, they do have certain illustrative criteria that one must look at before deciding whether a recovery is a reimbursement or disbursement. Essentially, these require one to look at who is the contract with, who is the actual beneficiary of the service or the goods that are being received, in whose name is the invoice received from the third party or the original supplier. So before any recovery is treated as a disbursement and treated as outside the scope of Oman VAT, we would encourage people to look at the criteria in this regard. If we move on to the next slide, we look at certain other transactions which are prevalent in the consumer and retail sector, starting with remuneration in kind. As I mentioned earlier, consideration essentially includes everything that a supplier receives or is expected to receive, whether it's in cash, whether it's in kind. So when there is an element of or a component of non-cash related consideration, even that would need to be included in the taxable value and offered to VAT. If there is any difficulty in determining the value of supply, one can look at the valuation rules for arriving upon the fair market value, which essentially is the value of identical or similar supplies in similar quantities in similar circumstances. If one is not able to derive the fair market value based on identical or similar supplies, because they may not exist at the time of supply, one can look at the cost, add a certain profit markup which is reasonable, and then use that as a fair market value. So valuation rules play an important role when there is remuneration or consideration in kind. Barter transactions, these essentially mean there's supply by two parties in kind, and what the VAT legislation requires and guidance in the region as well as globally require is that each supply is treated as a separate supply, is valued separately, and offered to tax separately. Whether parties can take input tax credit of VAT incurred on the purchase is something that would have to be assessed separately. Exchange or partial trade-ins, when there is a sale and the customer, in addition to cash, also trades in certain goods, used or otherwise. In this case, again, the same principle as remuneration in kind. The supplier will have to look at the full market value or the full sale price, and VAT will have to be paid on the cash component received in consideration as well as the non-cash component. When we look at deposits, refundable deposits are not subject to VAT, they're outside the scope. But before you conclude that a particular deposit is refundable, it's important you look at the documentation in terms of the contracts. You look at the accounting to ensure that in the books also this is recorded as a refundable deposit. Because to the extent a deposit is non-refundable or is expected to be applied to a supply to be made in the future, these will not be considered as outside the scope of VAT. These will be subject to VAT if applicable. So far as service charges and gratuity payments are concerned, these are a commonplace in the hospitality industry. When you go to restaurants, you charge a service charge, you may decide to give a tip. To the extent the service charge is compulsory, is shown on the invoice, it is usually deemed to be a part of the consideration and is liable to VAT. But when it comes to tips or gratuity payments, which are not shown on the invoice or are paid by the customer or the guest at their own discretion to individuals, these can be treated as outside the scope of VAT because these are receipts by the individual and not a consideration for supply made by the taxable person. If we move on to the next slide, we take on the subject of deemed supplies, again a commonplace in consumer and retail sector. Before we go through some of the exceptions, let me refresh the concept of deemed supplies. Normally, in order to qualify as a supply, a taxable supply which is liable to VAT, there are a few essentials a transaction needs to satisfy. There should be a supplier, there should be a recipient, there should be an underlying taxable supply of either goods or services in exchange for a consideration. And in order to be taxable in Oman, all of this should have, the taxable supply should have deemed to have taken place in Oman. In the absence of any of these essentials, one can say that the transaction is not that of a supply and therefore not liable to VAT. But the VAT legislation in Oman, like a lot of legislations within the region as well as globally, acknowledge the concept of deemed supplies, where even if one of the considerations or one of the criteria for supplies is not satisfied, in the eyes of VAT or for VAT purposes, it will still be deemed as a supply and subject to VAT. The manner in which the VAT legislation in Oman uh, expects to levy VAT on these transactions is it expects the supplier to either charge or pay a VAT on the output and deposit that with the tax authority, or forego the input VAT credit which it has recovered on the purchases used to make such a supply. The concept of deemed supply, remember, comes into place only where the supplier has recovered input VAT credit on purchases used to make such a taxable supply. Now, the VAT legislation makes certain exceptions to deemed supplies in Oman. First is in the context of low value items, where again, given how the sector operates, the VAT legislation acknowledges that gifts or free samples are a common commercial practice, and therefore it makes exceptions from deemed supplies where gifts or free samples are distributed for promoting a business or product, provided that certain monetary thresholds are met. So any gifts or free samples where the value of such gifts or free samples per recipient per tax year, which is a calendar year, does not exceed Omani Riyals 50, these are not deemed to be deemed supplies. You do not have to pay a VAT on it or forego input tax credit to the extent the transactions are within the monetary limit of 50 Omani Riyals. The exception is also for gifts or free samples where the total value for all recipients in a tax year does not exceed 1000 Omani Riyals. So as and when you make or distribute gifts or free samples and you exceed the value, the VAT applicable is only on the excess value. If you look at the financial services sector guide, it also makes exceptions for certain commercial considerations. This is in the context of waiver of fees from a customer, where the financial services guide in Oman clarifies that a waiver will not be treated as a deemed supply if the waiver is made for commercial considerations and the business retains documentary evidence of the commercial considerations or the business reasons. The waiver is for a customer, for an existing customer from whom the business or the supplier expects to receive some consideration for other supplies in the future, and that no purchases by the business are directly linked to this transaction, which is expected to not qualify as a deemed supply. Again, will have to be applied on a case-to-case basis. Free supplies. Now, in the sector, it's common to have different types of scheme. One of them is where goods are supplied free of cost or distributed free of cost. And the other is where the customer is eligible for a free product only on the purchase of a certain product or certain quantities of product. So let's say buy one, get one, or buy 10, get one. Now, when it comes to the latter, which is where the customer's right to receive a certain product is dependent on him purchasing certain goods or services, these are usually viewed as conditional supplies, where the transaction is looked at as a whole and the total consideration received for 1 + 1 is what is deemed as the consideration for the entire transaction. It is usually not seen as a free supply and is therefore not treated as a deemed supply. The total consideration for all the products issued is considered as consideration and subject to tax without the requirement to forego any input tax credit. If we move on to the next slide, we look at the position of the VAT legislation in Oman on inventory and stock related transactions. Return goods, a supplier is eligible to adjust the value of supplies if the goods or services are returned on the condition that where it is in the context of supply of goods, the goods are returned within 3 months from the date of supply and that no party benefits from the return. And in order to effect the adjustment, it's important that the taxpayer or the business, the supplier, issues a valid credit note for the adjustment and the recipient adjusts the reciprocal input VAT credit. So far as lost, stolen, or damaged goods are concerned, the Oman VAT legislation makes concessions where if the tax authority is notified within 30 days and the tax authority has the right to inspect the goods that are claimed as lost, stolen, or damaged, the business that has suffered such loss, theft, or damage does not have to reverse the input VAT credit incurred on such goods. In order to ensure that there are no surprises in audit, it's expected that the taxpayer maintains an audit trail and documentation of all the goods, the description, the value. In case of perishable items, it may be advisable for businesses to approach the tax authority for a blanket approval, provided that the supplier or the taxpayer is able to establish that there is proper process and appropriate checks and balances to ensure that input tax credit is availed only where it's absolutely eligible. Um, in terms of consignment stock, the clarification issued in the oil and gas sector guide provides that the date of supply in case of consignment stock is when the goods are placed at the customer's disposal. Does not matter when the ownership is transferred. Even if the ownership is transferred at a later date or a later point in time, as soon as you put the customer in physical possession of the goods, that will trigger your VAT liability. If we move on to the next slide, just a couple of other miscellaneous points before we wrap up this section is supplier contribution for marketing expenses. Now, this is a contentious issue, and the tax authority in Oman hasn't issued guidance in this regard. But if you look at guidance available in the rest of GCC, it suggests that where a local distributor incurs certain costs on account of building the brand or promotional activities for a principal who's overseas and recovers such amounts for promotional activities from the overseas principal, these are treated, the recovery is treated as consideration towards supply of services. And given the nature of service or activities involved, it is possible that even though the principal is overseas, this will not qualify as an export of service because the benefit of such service may deem to have arisen in Oman or accrued in Oman because it's towards building the market in Oman, and therefore such recoveries, depending on the nature of recoveries, could be subject to VAT at the standard rate. And in the absence of a non-resident business scheme, or because the principal is not present in Oman, this may become a cost to the principal. So contracts will have to be evaluated and schemes will have to be looked at before taking a position on the taxability of suppliers' contributions from marketing expenses. So far as shelf rentals, listing and placement fees are concerned, these are usually charged by supermarkets or hypermarkets. Often supermarkets or hypermarkets tend to net this off from the payments that they are supposed to make to the suppliers, which would be inappropriate. Both transactions, one of supply of goods by a supplier to the supermarket or hypermarket, and the transaction of charging shelf rentals, listing or placement fees by the supermarket to the hypermarket are two separate transactions, will have to be offered to VAT separately, for which tax invoices have to flow from both parties to each other. With that, I'll wrap up this section and ask Manak to touch upon certain procedural reliefs and issues peculiar for the retail and consumer sector.
Thank you, Abha, and good morning to all the attendees. Over the last 1 year, the tax authority has extended several procedural reliefs relating to VAT compliances. To start with, the due date for filing of VAT return and making the tax payment. The VAT legislation requires the taxpayer to file the VAT return and make the tax payment by 30th of the month succeeding the end of the tax quarter. The Oman VAT legislation does not allow an automatic extension in the event the VAT return or the payment due date falls on a weekend or a public holiday. But in the financial sector guide, the tax authority has clarified that if the VAT return and the payment due date falls on a weekend or a public holiday, the due date will shift to the next working day. On exchange rate, in case of transactions effected in foreign exchange, the VAT legislation requires the VAT amount to be converted into Omani riyals using the average buy and sell rate published by the Central Bank of Oman on the date of supply. The CBO rates for each day are updated before 2 p.m. but not consistently at the same time. In the financial sector guide, the tax authority has clarified that if the CBO exchange rate is not available on the date of supply, the taxpayer can use rates published on the previous day. Moving on, unlike VAT legislations in other GCC countries that generally require a business to issue a tax invoice within 15 days from date of supply, the Oman VAT legislation does not prescribe a timeline. But in the financial sector guide, the tax authority has clarified that invoices should be issued within 15 days from the date of supply. Now, the taxpayers also have an option to issue summary tax invoices at the end of the month for all the supplies made during the month, which is practically being followed by most of the banks. Technically, the summary tax invoice is required to contain all the details required on a normal tax invoice. The financial sector guide, however, has clarified that if a taxpayer has challenges in incorporating all the particulars as required under the legislation in the summary tax invoices, they can reach out to the tax authority to get special dispensation in this regard. Moving on to clarifications. Unlike the VAT legislation in other GCC countries, the Oman VAT legislation does not allow taxpayers a formal mechanism to obtain advance rulings or clarifications from the tax authority. But in our experience of dealing with the tax authority, we have had fair share of success obtaining private clarifications on behalf of the taxpayer. Now, these clarifications, since private, are binding only between the tax authority and applicant taxpayer. On input tax apportionment, the VAT legislation requires a taxpayer effecting both taxable and exempt supplies to undertake input tax apportionment working at the end of every tax quarter, followed by an annual true-up or true-down as the case may be. In the financial sector guide, the tax authority has clarified that subject to certain conditions, a taxpayer may compute input tax apportionment for the first 3 quarters of a tax year based on previous year's partial exemption ratio and the last or the fourth quarter based on actual figures. To avail this relaxation, the tax authority does not require the taxpayers to obtain an approval, but it is always advisable to notify the tax authority to avoid any surprises in the future. On refunds, unlike other GCC countries, which took a slightly longer time to process the initial refund claims, the tax authority in Oman started processing and dispersing refund claims filed by the taxpayers relatively early. In our experience, genuine claims have been credited to the taxpayer's account within 2 to 3 months of filing the refund claim. Also, in terms of procedure, the taxpayer is now required to file a quarterly refund claim through the taxpayer checklist separately and not at the time of filing the return. On deemed supplies, if we look at the financial sector guide, the tax authority has clarified that the provision of deemed supply may not trigger in certain situations, such as a fee waiver, but that is subject to certain conditions, which Abha had already discussed in the previous slide. And finally, the tax authority has been allowing deferment of VAT payable on import of goods to the date of filing the return instead of paying it upfront in cash, but on submission of a bank guarantee. Now, this has helped many taxpayers optimize their working capital requirements. Having said that, it is necessary for the taxpayers to monitor their bank guarantee balance with the tax authority on a regular basis. Every time a taxpayer imports goods under deferment, the VAT due is reduced from the value of bank guarantee. So, in tax periods where a taxpayer has significant imports, the bank guarantee may be depleted fairly quickly, and if the bank guarantee balance with the tax authority is lower than the VAT due on the next import, the custom clearance could be stalled and could lead to demurrage. With this, I like to move on to the other next slide, where I want to discuss our experience on compliances undertaken in the last year of VAT implementation. On returns, unlike other GCC countries, in Oman, among other things, a taxpayer is also required to report details of purchases and sales of capital goods and procurements which are outside the scope of VAT. In our experience, these details are not properly tagged in the IT systems and as a consequence, not necessarily captured or captured incorrectly by the taxpayers. To avoid penalties for incorrect reporting, it is critical that taxpayers find ways of capturing and reporting these details correctly in the VAT returns. In case of import of services, the VAT legislation requires the taxpayer to put a note on the overseas vendor invoice stating that the VAT liability is paid under the reverse charge mechanism. In our experience, it is not uncommon for the taxpayers to miss this requirement, which technically is a non-compliance. In case of import of goods, it is critical to ensure that all imports made either directly or through agents where the taxpayer acts as importer on record are captured correctly. It is equally important to ensure that the custom documents, i.e. the bayan, are in taxpayer's name, especially when a third party is engaged to clear the goods from customs. Unless the taxpayer owns the goods at the time of import and acts as the importer on record, the taxpayer may not be eligible to claim the credit of import VAT paid. On input credit, unlike most of the GCC countries that only allow taxpayers to claim input credit of VAT on procurements in the same tax period or the subsequent tax period, the Oman VAT legislation provides a period of 3 years. Therefore, it is advisable to claim input credit only where valid supporting documents are in place and there's no doubt in eligibility of credit. Excess claim of input credit could result into short payment of VAT and as a consequence, additional tax and administrative penalties. In case of certain nominal value supplies, the VAT legislation allow taxpayers the option to issue a simplified tax invoice. The VAT legislation does not specifically deny input credit of VAT claimed on the basis of simplified tax invoices. This is consistent with the legislation and practice in other GCC countries. But in a few stray cases, we have seen the tax authority deny input credit of VAT claimed based on a simplified tax invoice. On foreign exchange, as we discussed in the previous slide, the exchange rate should be the average buy and sell rate published by the Central Bank of Oman on the date of supply. Unlike UAE, Oman does not specifically allow taxpayers to rely on other sources like Thomson Reuters or Bloomberg. Lastly, on employer-employee transactions, the taxpayers need to evaluate the VAT implications considering they are treated as related persons for VAT purposes. We've already discussed the refund in previous slide, and hence I'll move to certain other VAT compliance related aspects. On other aspects, the most important has been the need for declarations and indemnifications where a supplier claims zero rating on supplies. Typically, these supplies may be supplies to oil and gas sector, supplies to special zones, or supplies related to qualified means of transport. The guides issued by the tax authority requires the supplier to retain confirmations or declarations on the conditions for zero rating from the customers. It is indispensable for the suppliers to have these confirmations and declarations on record, and also for the recipients issuing these confirmations to examine whether the conditions for zero rating are genuinely satisfied. Adding appropriate indemnities in these declarations will only help with recourse in case of future dispute with the tax authorities. Considering these complexities and peculiarities around compliances in Oman, it is essential for taxpayers to have an effective and efficient compliance process. To help clients achieve this, we at KPMG follow a technologically enabled approach to assist clients in building a robust and effective VAT compliance. As we move to the next slide, you would see a snapshot of the KPMG compliance solution, which is designed to support all sector clients. As part of this solution, we have a tech-enabled process to cater to clients, whether their data is available in a structured form coming from sophisticated ERPs like a SAP or Oracle, or in unstructured form. The data once shared with KPMG is converted into a machine-readable form, and then it goes through the proprietary solution where about 80 plus validation checks related to data sanity, consistency, and accuracy are undertaken. After undertaking manual adjustments on account of validation errors identified, the VAT returns are auto-generated from the KPMG solution along with other useful reports and MIS dashboards such as reconciliations and trend analysis. With this, we aim to automate the compliance process with minimal human intervention. Moving to the next slide on issues for consideration. While the guides have provided clarification on various matters, there are still certain issues which require due consideration. To start with loyalty programs. It has been a common practice in the retail sector for companies to operate loyalty program schemes as a marketing promotion tool and also to maintain customer loyalty. Some of the classic examples of these programs include stamp cards, which we generally see at coffee shops, wherein the customer is given, say, after buying coffee 9 times from the same shop and collecting stamps on every purchase, a coffee free on the 10th purchase. Then there's another common example where retail stores grant loyalty points on every purchase made, which can then be used to make a free purchase once sufficient points gets accumulated. The question which arises is the VAT applicability on such free purchases of goods and whether these qualify as deemed supplies. The answer to which would depend upon various facts as to whether such loyalty schemes are established for genuine purposes, are these open to general or large customer base, and can it be said that the value of free purchase has already been recovered in the previous supplies. All these will need to be analyzed for coming to the right VAT treatment on these loyalty programs. Second, benefit test on export of services. As Abha mentioned in the previous slides, zero rating on export of services in Oman is subject to a condition that the benefit of service is getting accrued outside Oman. While the Oman law is still silent on the benefit test, in the financial sector guide, it was briefly touched upon that the benefit test will depend upon various factors such as nature of service, the location and the presence of recipient in Oman, and also the accounting treatment. Therefore, in the retail sector, it becomes imperative to analyze whether the zero rating is available on recoveries made or spends done in Oman by local retailers from the overseas suppliers, which result in promoting the brand of the overseas supplier in Oman. Next, supplies to government or quasi-government entities. The Oman VAT legislation does not provide any exemption or special treatment for supplies made to government or quasi-government entities. The supplies made will be applicable to standard rate of VAT unless specifically exempt or zero rated by virtue of any other provision. The tax authority has also issued a notice to this effect, considering the initial issues faced by various companies in collecting VAT from government organizations. Another issue seen on supplies made to the government bodies has been in transitional long-term contracts, where in absence of any VAT clause, the government has been refusing to honor VAT charged by the suppliers. This makes it important for taxpayers to hold commercial discussions with the government and also be cautious while executing future contracts to have proper VAT clauses. Next, eligibility of profit margin mechanism on goods procured to implementation prior to implementation of VAT. If you look at the scope and conditions for profit margin scheme, as mentioned in the regulation and also the guide issued, there is no restriction on the taxpayer to apply profit margin scheme on goods procured prior to VAT implementation, subject to all the other conditions getting satisfied. Having said that, if we look at the guidance issued by the Federal Tax Authority in UAE, there does exist a condition both in the legislation and the guidance which provides that the profit margin scheme will be available only for goods which have been subject to VAT in the past. While the Oman legislation does not provide any restriction, considering the contrary guidance in UAE, opting to take a clarification from the Oman Tax Authority out of abundant caution can be a good measure. Lastly, on asset financing, there are usual business arrangements in the retail sector where a bank or a finance company is interposed between the dealer and the purchaser. These are widely known as third-party finance arrangements. These sort of finance arrangements often lead to a lot of complexity and open questions from a VAT perspective, such as who is the customer for the dealer and in whose name the invoice should be issued? Who is eligible to take the input credit of the VAT charge by the dealer? Is there a VAT on installments charged by the bank to the purchaser? And what is the VAT applicability on charges recovered by the bank in addition to such installments? A careful and a thorough analysis is required under VAT for such business arrangements. With this, I'll hand over the presentation back to Abha to discuss some key next steps.
Thanks, Manak. So mission critical items for businesses. Examine the taxability of supplies. For the consumer and retail sector, you need to look at whether there's a zero rating, whether there's exemptions, how are deemed supplies being treated, do you have discounts for employees or any fringe benefits extended to employees? So look at the taxability of supplies, including deemed supplies. Where you have trade schemes or policies, you want to look at the treatment of the trade schemes with your end customer, but you also want to look at the tax treatment of recoveries you make from your principal. Wherever there is any ambiguity or weakness, reach out to the tax authority for clarifications. Wherever there is a need for approval before you take a certain position, reach out to the tax authority for that approval. Now, revisit positions based on the guides that have been issued by the tax authority. I understand that there's no guide available for the consumer and retail sector, but a lot of the guidance that we've put before you in the session today is based on other guides which have been published by the tax authority. In addition to that, you have enough guidance coming from the guides published by Bahrain and KSA for the consumer and retail sector. To the extent you think there is a need to course correct or revise tax positions, make sure that you course correct voluntarily. You don't wait for tax authorities to assess you and find out gaps in the course of assessments. They have 3 to 5 years to assess you, so that is a long time to go. Wherever there's a course correction required, update your contracts, purchase orders, whatever documents you have with your customers or your vendors. And to the extent necessary, make sure you make simultaneous changes in your ERP systems, your customer masters, vendor masters, accounting treatment, accounting entries, and ensure you communicate regularly with your internal and external stakeholders, whether it's for commercial negotiations, whether it's for clarifications, or just to disseminate information on tax positions being taken or changed by finance. And often we've seen that a lot of mistakes or omissions happen because of lack of understanding by users. Users could be people putting in accounting entries, users could be people selling or drawing up contracts. Make sure you take appropriate user trainings on a periodic basis to ensure everyone's abreast with the positions that they need to communicate or take. And your reporting to the tax authority ultimately is based on the returns that you file. So make sure that they are complete and correct. To the extent there's a revision required, the legislation allows you to do that. So take the opportunity and course correct voluntarily instead of waiting for an auditor assessment, because the penalties under the Oman VAT legislation are eye-watering, and VAT audits and assessments are just around the corner. So with that, we'll wrap up the session for today. We'll move to Q&A. I know we've exceeded the time. We only have 5 minutes, but we'll try and extend the session to accommodate a few more questions. So to the extent your schedules allow, please stay on the call. With that, let me first pose the first question to Mohammed. Mohammed, are taxpayers required to advertise prices of goods and services inclusive of VAT or exclusive of VAT?
Well, the price of goods and services shall be presented inclusive of VAT. Failure to do so may be considered as non-compliance by the taxpayer and could result in administrative penalties.
Thanks. Extremely important for taxpayers, and it's not just on websites, but also on any printed material, brochures, as well as displayed prices in supermarkets. So important point made by Mohammed there. Manak, I'll put the next question to you. This is in the context of deemed supplies. The question is, are testers in the beauty business allowed for input VAT recovery?
Thanks, Abha. So let me put the answer in two parts. One, there are testers which are there in the store, which people generally use and buy the final goods. So if these are testers which are consumables in a retail store, they would be eligible for an input tax recovery. Now there may be other testers which may be used as samples which are given to the final customers, in which case the store would need to look at the limits which are prescribed, as I discussed in the earlier slides. So there are two things. One, if the tester is used as a consumable, it would be eligible for input tax recovery. But if these are given on samples, you would need to check the limit which is prescribed in the law.
Thanks, Manak. Maybe I'll take the next one, which is on profit margin scheme. Can you throw a little more light on the inclusions and the conditions of the profit margin scheme? So the tax authority, apart from giving guidance in the VAT legislation, has also issued recently the profit margin scheme guide. Profit margin scheme is an option, not mandatory, available to businesses who are in the regular business of buying and selling used goods. The scope of used goods is defined and includes tangible goods. It also includes certain types of antiques and certain assets which are collector's assets like stamps, coins, but it specifically includes animals, precious stones, precious metals. So you want to look at the eligibility of the item before you opt for applying VAT under the profit margin scheme. What does the scheme mean? The scheme means that you only pay VAT on the profit that you make on the trade. This is essentially to avoid any loss of VAT that is incurred on the purchases. So it's only the profit on which you charge VAT, and in order to arrive on the profit, so if there's a loss or if there's no profit, then obviously there is no VAT applicable. But if you've accumulated losses over transactions, you cannot set them off against other transactions. Each transaction is looked at independently, and the profit that you make on every transaction is treated as inclusive of VAT. So you need to work back the VAT on the profit as if it's inclusive. When are you eligible to charge VAT under the profit margin scheme? In order to qualify or be eligible, you need to ensure that you have a specific approval from the tax authority to charge VAT under the profit margin scheme. You need to ensure that the goods that you're dealing in are located in Oman, and that the purchases of used goods are either from a non-taxable person in Oman, i.e. unregistered customer, or it is from another person who's calculated VAT under the profit margin scheme, or from a taxable person who has not been able to recover input VAT incurred on the purchases. When you look at the profit margin scheme, there are certain inclusions and exclusions from the purchase price and the sale price. So anyone opting for the profit margin scheme needs to look at the profit margin guide for additional guidance. Let me put the next question to Mohammed. Is there a formal mechanism introduced in Oman for claiming VAT refund by non-residents?
While there is a provision for non-residents to claim refund of VAT paid in Oman, subject to the prescribed conditions and bearing certain goods and services. However, at present, there is no formal mechanism to file and obtain refunds from the tax authorities by non-residents.
Thank you, Mohammed. I'll put the next question to Manak. Manak, this is in continuation to something I discussed on the slide earlier. VAT on rebate and rental income from supermarkets are not being dealt with in a uniform way. Some are charging VAT at 5% on their total income, while some are charging only on the rentals and rebates of VATable items. What is the correct way of charging VAT on this income? I'm assuming the question is from a supermarket's perspective. When a supermarket is charging rebates or recovering rebates and rentals from the supplier.
Yes, thanks, Abba. So, I think we already discussed this in the previous slides also, that if the supermarket is recovering any listing fees, any rental incomes, or any sort of promotional reimbursements from the suppliers for keeping their goods in the supermarkets, these are services which are performed by the supermarkets for the suppliers, and these will be liable to 5% VAT. Now, these would not depend upon whether the goods are zero rated or not, because these are separate supplies. However, if the supplier is extending a post-supply discount to a supermarket, which may be due to sufficient quantity being purchased by supermarkets, then the supplier will need to evaluate whether the credit note has to have a VAT or not, depending upon the product for which the discount is offered. But if these are supplies which are made by supermarkets to suppliers, such as rental income or listing fee, these would be liable to 5% VAT.
Thanks, Manak. I can probably take the next one. What would be the VAT implications in case of special discounts offered to employees by retail stores? Now, for the purposes of VAT, an employer and employee are treated as related parties, and transactions between related parties under the Oman VAT legislation need to be assessed at fair market value, which means that if a supplier extends a special or additional discount to the employee compared to anyone who's a third party customer, the valuation of the transaction between the employer and employee will have to be at the fair market value, even if the supplier does not recover the full consideration from the employee, even if the employer decides to not charge the VAT on the full value from the employee. So far as the reporting of the supplier with the tax authority is concerned, this would have to be at fair market value. We've already discussed the principles of fair market value earlier. Manak, I'll probably put the next question to you. Any update on pantry expenses or vehicle fuel and repair expenses which are incurred during the normal course of business? Are they eligible for input credit?
Thanks, Abba. So the Oman VAT law specifically restricts any input VAT on food and beverage catering or motor vehicle related expenses, subject to motor vehicles being available for personal use and office use both. So if the motor vehicle is being used both for office use and private use, which happens for most of the business arrangements and which is usually the phenomena, then the credit would not be available on repairs of motor vehicles or procurement of such motor vehicles. And similarly, pantry being related to food and beverage catering, again, the credit for this would also get restricted. So apologies, but the credit for both these items would not be available due to specific restriction in the Oman VAT legislation.
Thanks, Manak. Next question, maybe I can take this. As a customer, whether input VAT need not be reversed for stock returned to vendor after 3 months. So here the assumption is because the stock is returned after 3 months, your supplier is not in a position to issue a credit note or adjust the value of the original taxable supply. And if your supplier is not able to adjust the value of supply, then as a recipient, you do not have to necessarily adjust the input VAT credit that you incurred on the purchases. But technically, the question that you need to ask is whether you've used the purchases, the goods or services in the course of business. That's the primary requirement or the primary input VAT recovery rule. If you've made a purchase, but you never used it in making a taxable supply, and you're really basing the recovery of input VAT credit on an invoice, when the goods or services are not consumed, are you even eligible to recover input VAT credit? Forget the issuance of a credit note by your supplier. we've got many questions. We will not be able to cover them, but let me just take the last one before we wrap up the session today. It's on consignment stock date of supply. The rule seems different across the GCC, as the time of supply would be consignee sells the stock to the end customer. Is Oman law different? So as I mentioned earlier, if you look at the clarification which is issued in the oil and gas sector guide, in the context of reserve stock, which they've also called as consignment stock, it suggests that in an arrangement where goods are put by the supplier at the disposal of the customer for the customer to draw on at any point in time, and it does not specify whether it's for use by the customer or for onward sale by the customer. It just talks about goods being put at the disposal of the customer by the supplier. The guide clarifies that the time of supply is when the goods are put in the physical possession of the customer, even if the ownership happens at a later point, transfer of ownership happens at a later point in time, which is different from some of the other GCC countries where guides clarify that in a consignment sale, there is sale by seller A to seller B and then seller B to seller C. And all these transactions of sale happen simultaneously at the same point in time when seller B sells to the ultimate customer, which is seller C. There's assumed to be a back-to-back purchase and sale between seller A and seller B. So yes, to that extent, the clarification issued by the tax authority in the oil and gas sector guide is different from what some of the other GCC countries adopt as rules for time of supply. With that, we will bring a wrap to the session. Thank you again for your participation. To the extent we were not able to get to your questions, we apologize, but hopefully we'll be speaking soon. You can write in to us and we'll try and respond to your questions. Thank you for your time and have a great day.
Thank you all.